we had here our look into the past. From that, we determined our historical returns, right? And then we basically said, so suppose, and this can be the case, suppose we do not have any better information in terms of how the future develops for a particular firm, then our best guess about the future, about expectations could be, we assume that the returns evolve, well, as the returns from the past. That can be the case. However, could also be the case that, well, we assume that there are some predictions about the future, which would make us able to calculate here our expected return in the following way. So let's consider the following example. Next year, there are 3 possible states of the economy with, with different probabilities. So in 25%, you would have a recession, 50% neutral state, and in 25% a boom. Suppose we have 2 stocks that we are analyzing now, stock A and stock B, and depending on the states of the economy, also their returns would evolve. So apparently stock A is a pro-cyclical stock, right? Because you see that in a recession, the stock would generate negative return. In a neutral state, well, positive and 15%, quite good return. And in a boom state, even 35% return. Whilst stock B, in case of a recession, so it would be a counter-cyclical stock, would generate 30% return. In a neutral state, as stock A, 15%, and in a boom state, minus 10%. Now, based on the considerations that we have assumptions about the likelihood of each of those states, as well as there are expectations about how the returns would evolve in those different states of the world. So here we have some kind of analysis going on, maybe some experts sat down or internally or whoever, the stock market in general says that these might be the states of the world, and in these states of the world, the stock might devalue as follows. Then, if we have the probabilities given, and if we have the returns or the potential returns given, our expected return would be, well, the sum of weighted probabilities of the expected returns. So for stock A, this would mean with a 25% chance, we will get minus 20%. With 50% chance, we get 15%. And with 25% chance, we get 35% return, which would give us an expected return of stock A of 11.25%. Stock B, by analogy, in 25% of the chance, we would get 30%. In 50% of the chance, you would get 15%. And in 25% of the chance, you would get minus 10%, which gives you an expected return of 12.5%. So far, so good. Now let's take a look at volatility, meaning variance and standard deviation. Here, we would apply the same rationale as we did before. Recall, in the variance, we subtracted our returns with our expected returns with the square root. We do the same thing here. Now, considering that there are these 3 potential states of economy. So everything else the same, a 25% recession and 50% neutral, and in 25% boom. We already calculated, as you can see in the previous slide, the expected values. So for stock A, the expected return would be 11.25%. For stock B, our expected return would be 12.5%. Well, and now we can apply this formula of the variance to calculate for each of those stocks either the variance, or we can directly take the square root of the variance and generate the standard deviation. And here, I think it's the first time we implement this terminology or the way of expressing it. So one way to write standard deviation would be SD of R, but also a typical way to write both variance, or to write the variance and standard deviation, is form of this sigma, of this letter. So the variance would be sigma squared. So you could also plug here ahead sigma squared of R is equal to the variance of R. Well, and the square root of sigma square is then sigma, and this is then the standard deviation. So this nomenclature should not be a problem for you. So when you read here sigma of RA, this is the standard deviation of stock A, right? So let's apply this formula in 25%, and let's apply this formula starting with stock A. The standard deviation is the square root. So here the square root, the large square root, comes from this formula. It is simply the square root of the variance. So now what lies within the square root is the variance formula. The variance formula we have here. So applying this variance formula to the stock, we now see in 25% of the cases, we have a return of minus 20%. We subtract from this minus 20% the expected return being 11.25%. And then we take the square root, we take this to the power of 2. Now we add, it's the sum formula, plus, well, what is the second state? The second state is the neutral state in 50% of the cases, times the return, which would be 15%, minus the expected return, which is 11.25%, and take this to the power of 2. And plus the third state. The third state is the boom state. In 25% of the cases, we get a return of 35% minus the expected return of 11.25%, and take this to the power of 2. Right? Which would then in total give you, once we calculated this, a standard deviation of 19.8%. Well, and the way to handle this standard deviation would exactly be the same, as we've discussed before. But now we calculated it based on expected future returns. The same thing you could do then for stock B. I will not go through it in that much detail. You would exactly do the same thing. You would say the standard deviation of stock B is the square root is the large square root of the variance having the formula as specified above, and you would then apply something as 4, right? So you would have 25%. You would have 25% times return, 30% minus the expected value. The expected value for stock B would be 12.5%. Well, and then you would take this to the power of 2, and you would do it for the other terms in the same identical way as before. And what you would then get as a result, once you calculate this, is that the standard deviation of stock B would be 14.36%. So far, so good. I need to take care of these notifications in a second, but let's continue. Good. So I hope that this is clear so far. Now I would like to make with you a short, as I hinted to in the very beginning of our session, I would like to talk a little bit about preferences and utilities, however, while it's not making this too long. So utility functions are basically able to represent individuals' preferences for certain things. Normally, we could think about it, having a preferences for how do you relate apples to bananas with each other, but you can also extend it. How do you relate consumption today versus consumption tomorrow? What is your preference about risk and returns and the like, right? Utility functions give you a way to mathematically represent those preferences. I will now skim a little through these slides because you will cover them in detail in your microeconomics class, but nevertheless, I think it's valuable to also mention these concepts here, simply to give you an understanding also how risk and return can be linked to each other in terms of persons' preferences. Normally, we would say, and I think most of us will agree that, well, more is better, right? If we have more goods, it's better. If we had these more goods rather safely than uncertain, probably we would also prefer it, right? If someone offers us $100 for sure versus $100 in somehow context of a bet, so maybe you get the 100, maybe you don't get them, probably we would prefer the surer over the non-sure outcome. I mean, might be exceptions where people are risk neutral, but I would say in general, this is the case. And the reason why this is the case is risk and risk aversion, right? I mean, people in generally are risk averse, meaning we prefer certain outcomes to stochastic outcomes, right? Right. And in order now to make risk averse people invest in uncertain activities, we need to give them an incentive, meaning a kind of a risk premium, right? Which is somehow higher than the expected returns. We will come to this in the financial models in more detail. However, I just would like to emphasize that, in normal cases, right? I mean, you might also find people who are risk loving, risk friendly, but apart from those cases in which people might be risk friendly or risk seeking, also risk averse people might get incentivized to invest in risky assets. Yeah, and maybe this holds true for some of you. You would perceive yourself as a person who would prefer a safe outcome to a safe smaller outcome to an unsafe but on average larger outcome. And if this is the case, nevertheless, you might sometimes be willing to take risk, but you would need some sort of compensation for this risk. And we will also talk about compensation for risk in terms of risk premiums. We talk about equity risk premium and the like. So this is just a heads up and some sort of intuitive background, which should embed what we are going to talk about in a second on a more general, from a more general point of view, right? However, and this is also important to know, we should acknowledge that even if we do not take risk, we want some return. Meaning, and recall, this is the notation, if we have a standard deviation of 0, we still want to have some return in reality. And the reason why this is the case is, well, even if there is certainty, so suppose you know exactly how the future evolves, right? And for instance, that a company, or I don't know, a state, if you borrow the state money in terms of a bond, the repayment probability is 100%. So you borrow, for instance, a company or the government 100 euros, you will get the 100 euros back next year. Nevertheless, you would like to have more than the $100. And why is that? Well, because there are other generic, like global risks, such as inflation, or market-related risk. So, meaning, if you give someone something today, in terms of monetary terms, the value of this money you give him today, even if it's repaid fully in the next period, is value less than before. So you want to be compensated for that. So even, and this is important to understand, even if there is no risk in terms of volatilities, what we discussed before, you would some return, which is referred to as the risk-free rate. And this risk-free rate, think of it, I think this is the most intuitive case, that you want to be compensated for the risk of losing value in money due to, for instance, inflation, right? However, beyond this risk-free return, so here we have depicted return versus risk. So you see, even in the case where we have no risk, zero risk, we want to have a return. And then due to our risk aversion, what was described here beforehand, you know, people have preferences. They would in general prefer more than to less and surer to unsure outcomes. Well, people, even if even if there is no risk, they want some return because, well, of inflation and the like. And now, if there is some risk in whatever they decide to invest in, and the risk is above zero but low, they want to also have higher returns. And if it becomes riskier, they want to have a higher return, right? So risk and return are related in the form that, well, if you're taking risk by investing in someone or in something or an asset, you want to also be compensated in terms of return. There is no reason for you to invest in something risky and obtain the same return as you would obtain if you invested in something riskless, right? So this is also where this point steps in that I described initially. So you're confronted with an investment opportunity. It offers you a certain return. Then you have an information about the risk, right? And before responding to the question, if you invest to this or not, you're going to look at your alternatives, right? And if there was another investment alternative which would give you the same return, however, with a lower risk, then there should be no reason for you to go this route under the assumption that, well, that you're risk averse, kind of, right? That to take this, right? I mean, you might now argue, well, you know someone who really loves the risk and even, yeah, could be, right? But this is like, yeah, then his preferences should be modeled into a utility function which represent, well, that the joy of adrenaline, or, you know, this adrenaline factor should be priced in. But in general, I hope you would go with me the route that if you offered someone the same return for a lower risk versus this return with high uncertainty, to take the route where you take the less risky investment with the same return, right? This is, I think, what this part of the slides is about, which is important for you to understand. You can model this in different forms of utility functions. So I would not like to focus too much on these log utilities and quadratic utility functions. This is something I would like to leave to you to recap, right? This is not going to be the focus of our lectures or of the course. This is rather something which I would like you to keep in mind also when you're going to cover the course on microeconomics. And then once you covered this topic, also the modeling of these utility functions should get clearer to you. I also think the slides are self-speaking in the like that once you read them, you should understand how this relates to what we discussed in context of risk and return. However, for purpose of my didactical guidance through the slides today, yeah, I would ask you to take here these slides on log utility, quadratic utility function, and mean variance criterion, yeah, as something you read through yourself after our lecture today, yeah, because what I would like to do now is I would like to move further with analyzing what we started here, where we looked at expected returns and volatilities of single stocks. Recall, we did it by applying basically our probability sum function for the returns for stock A and B. And we did the same thing for the variance for stock A and B by applying those formulas. And now I would like to move with you a little bit beyond in terms of portfolio. What is a portfolio? Well, now we move beyond a single asset. Before we calculated the returns and the volatility and volatilities of a single asset. Now we will look at portfolios. Portfolios are combined sets of multiple assets. So suppose you do not only have one stock, but you have basically, yeah, a sum of stocks in your portfolio, right? So you do not have you do not have to choose between the stocks we analyzed before, right? Either stock A or stock B, right? But you can also combine them, and you say, well, I want to invest part of my money or part of the resources I have into stock A, and another part of them into stock B. And then I would ask myself the same questions. What about the resulting returns of this portfolio? And what about the risk? And this is going to be interesting because, yeah, I don't know how much I want to go ahead of this right now, but I will just mention one term, and this term is called diversification, right? We will see that if we go beyond investing in one asset, but investing in multiple assets, that this will have an impact on our overall risk. Yeah, and this is due to the diversification. And we will see this while going through the slides. And then hopefully you will also understand in how far this is relevant when it comes to pricing assets appropriately, right? So to make the storyline again, we started with analyzing historical returns, historical volatility of one asset. We then analyzed for stock A and B, their returns and their risk. So here, stock A return, stock B return. And here, stock A, the risk, 19.8%, stock B, standard deviation, 14.36%. And now we will take a very important next step, which is we look into portfolios. Right? So now suppose that we have here these two stocks. However, now we say that in our portfolio, which is basically a pool of or a set of multiple assets, and we are being told that in our portfolio, stock A makes 30% of our portfolio, and stock B makes 70% of our portfolio. We could refer this in two weights, meaning weight of stock A in our portfolio is 30%, and weight of stock B in our portfolio is 70%. what would be our expected return of this portfolio? Well, the good thing is we already calculated for the individual stocks their return. We know that the expected return, recall from our previous slides, this is what we've calculated. Here, we calculated the expected return of stock A was 11.25%. And of stock B, it was 12.5%. Now we can apply this knowledge in order to calculate the portfolio risk, the portfolio expected returns. How? Well, we would say stock A is 30% of our portfolio. So I will calculate 30% times the expected return of stock A, which was 11.25%, plus 70% times 12.5%. 70% times 12.5%. So the expected return of this portfolio would be the weighted average of the expected returns of each of the individual stocks. So 30% times 11.25 plus 70% times 12.5. So we would expect a return of 12.125%. So far, so good. What about the variance? What about the risk? I mean, recall with the individual stocks, we calculated the standard deviation of stock A is 19.8%. The standard deviation of stock B is 14.36%. A first guess could be, well, for the risk, we do the same thing as for the returns, right? So what would that then be? Well, one thought could be, well, let's calculate the weighted average of the individual standard deviation. So 30% times 19.8% plus 70% times the 14.36%. So we would also have the weighted average of the risk as our volatility of the portfolio, right? And here the answer is no, this is not the case. This is where diversification comes in. And this is where it's becoming interesting, right? Here, the variance of a portfolio is not calculated as, you know, the weighted average of these two variances, right? But this is a formula. We are not to mathematically derive it, but this is something you should believe from finance and yeah, from finance literature, that the variance of a portfolio, now if we're talking about a portfolio comprising of two stocks, is partly related to the variance of the first stock or stock A. Think of one as being stock A, plus the variance of stock B. However, here in quadratic terms. So this formula, you know, I will not decrypt to the very last part to you, but it's very important for you that you understand that it's not only comprising of variance A and variance B, but it is also depending on this factor rho 1, 2. And rho 1, 2 is the correlation between the two stocks. We will discuss this in more detail later in the slides, but already now I want you really to understand that if we take the perspective that we have a portfolio comprising of two stocks, the expected return of this portfolio is the weighted average of each of those expected returns, but the variance is not the weighted average of the variances of these two stocks, but it is specified as depicted here. So it is related to the variance of the first stock. It is related to the variance of the second stock, but it is also a function of the correlation of these two stocks. Right? And now, let's suppose we apply this equation, yeah, which I ask you, you know, this is something you should know, right? That the portfolio variance is the, if we have two stocks available, is the square of the variance of the first stock plus the square of, plus the square weight of the variance of the second portfolio, plus 2 times the covariance and the weighted factors with times the 2 standard deviations. I will not derive this formula mathematically, but we will see what the implications of applying this formula of the portfolio variance will be on the portfolio variance itself, right? We already derived before that our expected return of the portfolio is 12.125%, right? This is what we have. Expected return of the portfolio is the weighted average of these two individual returns. We still have the weight 30% of stock A, 70% of stock B. And now, and this is important, we have given in our formula this correlation coefficient of minus 0.32. We will discuss later what this correlation coefficient means specifically. Yeah, so, but for now, it should be enough for you to know that if this correlation coefficient, which can take values from -1 to +1, if this correlation coefficient is negative, this intuitively means that basically these two stocks evolve differently over time. And as I've already hinted in the very beginning, we said, well, stock A seems to move downwards in a recession, whilst upwards in a boom, compared to stock B, which moved upwards in a recession and downwards in a boom. So you see that already from these three states that the two stocks tend to move differently. When the one stock goes up, the other stock tends to go down. So this is contained in this correlation coefficient, meaning if the one stock goes up, then the other stock tends to go rather down, right? Doesn't have to hold always. If the correlation coefficient was -1, then they are perfectly negatively correlated, meaning it would always be the case if the one stock goes up, then the other stock goes down and the like. But if the value of this correlation coefficient is between or lower than 0, yeah, and bigger than -1, then you would say on average, yeah, on average, if the one stock goes up, the other one goes down. And now we will apply this correlation coefficient into our variance formula of the portfolio as described here by utilizing also what we have derived beforehand. Recall when we were talking about the individual stocks, we derived that the standard deviation of stock A is 19.8%. And if I now move down in the slides, we see that the standard deviation of stock A here, this is an information of something we already derived. It's 19.8%. And the standard deviation of stock B is 14.36%. And if we go up, you will see this is what we've derived here previously on the slide, right? So these informations we already had from our previous single asset analysis. However, for the portfolio so far, we only derived the return, and recall the return was the weighted average. Was the weighted average of the stock, of the returns of the individual stocks. And what we are missing is still the variance of the portfolio. And the variance of the portfolio we will now determine by applying this formula, which is depicted here, right? And recall the variance, or the relationship between variance and standard deviation is that, well, the standard deviation is the square root of the variance. And now we will apply this formula for the standard deviation of the portfolio. Standard deviation of the portfolio is the square root of the variance, and the variance formula, which I highlighted here, is the variance formula which you have in here. And now let's plug in W1 to the power of 2. So the weight of asset A. So here in this formula, you should replace 1 with the letter A and 2 with the letter B, right? So WA to the power of 2 is, well, 0.3 to the power of 2 times variance 1 squared. Variance 1, variance A squared is here, 0.392 plus 0.7 to the power of 2 times variance B squared, 0.0206 plus 2 times correlation coefficient rho minus 0.32, yeah, that we have, times W1 times weight A, 0.3, times weight B times 0.7, times standard deviation of A. Standard deviation of A is 0.198, times standard deviation of B times 0.1436. Well, and once you calculate this, you obtain a value of 9.91%. So this is the standard deviation of your portfolio, summarized here. So everything as we had. So this is basically the table summarized again, now with the filled values. So important, the expected return of the portfolio is the weighted average of the individual ones. So 0.3 times 11.25 plus 0.7 times 12.5. This is then 12.125. However, if you calculated the weighted average of the standard deviations, meaning 0.3 times 19.8 plus 0.7 times 40.37, you would not get 9.91%, which we calculated here, but you would get something that is higher than this 9.91%. And this is because the two stocks are negatively correlated, meaning, again, if the one stock goes up, then the other one tends to go down. And vice versa, if the one stock goes down, then the other stock tends to go up, meaning that the volatility which each of the stock individually has is partially canceled out by the movement of the other stock, which tends to go in the opposite direction. So the intuition for the volatility of the portfolio to be lower than the weighted average of the individual volatilities is due to the fact that, well, if the stocks are not or are correlated somehow, right, then this has an impact on the overall risk of the portfolio, right? And therefore, this is very, very important for you to understand that the portfolio volatility is not the weighted sum of asset volatilities, but less. This is the concept of diversification. Lower return, lower risk, while return is the same. We will come to this later, but basically one of the takeaways for you should already be, well, if I have a diversified portfolio, I might get in expectation the same return as if I invested, well, only in, you know, I will get the weighted average of expected returns, but I will have lower risk. So diversification reduces your risk by investing in more than in one asset. And we will come to this in a second. Now I would suggest let's give it another 5 minutes break. So let's continue. Yeah, let's continue. Now it's 17. Yeah, shortly past 20, 10 past 21, 20 or 22. Let's give ourselves 5 minutes rest to digest it. Maybe you reflect a little bit on this table, and then we will move a little beyond and talk then about the risk and return trade-off, right? So I know we take here a little time to understand. It's taking a little longer, but I think it's very crucial for you to understand this concept of diversification. We will dive into this in detail in a second. So let's give ourselves 7 minutes break to make a round number. Let's continue at 10:25, which is 11, 12, 1, 2, 3, 25 your time. But I think now we should have a short break to digest. So let's continue in a few minutes.